Everyone to today's webinar, Inside Morningstar's 529 Plan Ratings. Today's webinar will be led by Morningstar Senior Manager Research Analyst, Leo Atchison. Leo will speak for about 25 minutes, and then we will have lots of time for your questions. You can submit your questions through the Q&A panel on the WebEx interface. So with that, I will hand it over to Leo to get the webinar started.
Thanks, Jamie. Hey, everyone. Hope you're doing well. If I could just go off on a brief tangent real quick, I'd be remiss if I didn't mention something about the Cubs. I'm based here in Chicago, or in Morningstar's Chicago headquarters office, and wow, that game last night was really incredible. The majority of people here, I would say, are pretty much on cloud nine. It's a pretty incredible atmosphere. So anyway, congrats to any fellow Cubs fans out there. Now to the important stuff. Let's talk about 529 college savings plans. So here on this first page, I just want to provide a little bit of background in terms of some of the research that we provide. So every May, we release a landscape paper that focuses on what we consider to be some of the most pressing topics within the industry. A couple years ago, we focused on best practices and highlighted some of the things that we look at and evaluate when rating 529 plans. In this most recent year, it was a variety of topics such as glide path construction, manager selection process, and whatnot. So we release that every May. Actually, we try to release it on May 29th, which is 529, not coincidentally. And every October is when we update our 529 ratings. So that's what we'll be spending the majority of the time talking about on this call. I'd also mention that if you're looking for a lot of data on some of these 529 investment options, Morningstar collects a lot of that on over 4,500 options, puts them in specific Morningstar categories, and also assigns star ratings to all of them. This slide, just wanted to highlight some of the asset growth within the industry. We continue to see growth, and to be frank, that doesn't surprise us, as tuition has really become more and more expensive over the years. Investors are looking for the best way or how to make the most out of their college savings. So the tax benefits of 529 plans are undeniable, and you see more and more investors turning towards them. So we wouldn't be surprised to see continued growth within the space. Another trend that we've also seen is continued growth of direct sold plans over advisor sold plans, and now they actually take more assets. Another thing I'd like to point out, and this was included in our landscape paper this year, is while in some cases you see states with the most assets that you would expect, such as heavily populated ones like New York and Ohio, that's not always the case. It really depends on who you partner with as your investment manager, as well as if you sell your plan nationally or not. The most glaring example is Virginia, who has a little bit over almost 23% market share of the industry. That's largely due to the growth of their College America plan, where they partner with American funds and they sell it nationally. But anyway, it's just an interesting tidbit that we like to point out. Moving on to the ratings. So there's a 5-tier scale, and it's actually the same scale that we use to rate mutual funds. We have 3 recommended levels of ratings: that's gold, silver, and bronze. The difference being our level of conviction, I really try to outline, which plans are following the best practices. Gold-rated plans tend to follow the vast majority, if not all, of best practices, and silver and bronze are very strong options over the long term, but there might be a couple small areas for improvement. Neutral-rated plans often have some attractive aspects that offset some weaker ones, or sometimes there will be some kind of uncertainty that clouds future prospects of those plans. Meanwhile, negative rated plans have at least one major flaw that makes them, in our view, inferior offerings relative to their peers. And I would just like to reiterate that these are forward-looking ratings, and they're meant for investors that are looking, for a 529 plan. And of course, not short-term. All of our recommendations are long-term. I'd like to touch briefly on our process for evaluating these plans. We use a 5-pillar approach, which is also how we rate mutual funds. So the 5 things that we look at, there are a lot of similarities when evaluating mutual funds, but also some areas where we have to tailor our analysis to 529 plans. When we're looking at the people, we're mostly focusing on the quality of the underlying managers used within the plans. We view it as a best practice to showcase investments that earn medals from Morningstar's analysts, which means our analysts think they will outperform peers and indexes over the long haul, or at least offer investments from asset management firms with strong stewardship practices. When evaluating a plan's process, we spend a lot of time focusing on the asset allocation of the age-based options, trying to determine if it is a thoughtful approach, look into who designed it, what their track record is in the asset allocation space, and just overall focusing on the philosophy of the glide path and whether or not there's danger zones and whatnot. When evaluating the parent, there are two bodies that we're evaluating in this. We look at oversight from the state and from the asset management perspective. From the state, we prefer plans that have informed and engaged oversight with staff that are focused solely or primarily on administering the 529 plan, and also tend to be relatively insulated from political influence or turmoil. From the investment management side, we prefer plans that partner with investment managers with strong investment cultures, that also have long tenured portfolio managers, low fees, and generally incentives that align their interests with shareholders. Performance is relatively straightforward. We're looking at how a plan has performed on a risk-adjusted basis in the past relative to its peers. And we also consider what a plan's prospects are for its future returns. And finally, when looking at the price, we're looking at the total expense that it costs an investor to own a plan's investment options relative to similarly sold peers. And one thing that I would note here is that we do evaluate, when looking at price, we evaluate advisor-sold plans separately from direct-sold plans in order to make it more of an apples-to-apples comparison. Advisor-sold plans will be more expensive typically, but at the same time you are receiving an additional service, so we think it makes sense to divide them separately. I just touched on that first bullet point. I would also note that in evaluating these plans, while this is more the exception, there are cases where specific state benefits can offset weaknesses and can actually influence or change a plan's overall rating if they offer really exceptional benefits for instance, to residents for buying the plan. So that can sometimes influence a rating. Additionally, I would mention that not all pillars are equal weighted. Notably, performance receives the smallest weight, as we all know that past performance is not indicative of future results. And we also have a whole team of 529 analysts that get together to review the ratings and in a committee format and actually determine final ratings. This is a distribution of ratings this year. This is very much in line with what we've seen in the past. Very few plans receive gold ratings. We hold those plans to very high standards, and it's very hard to achieve that rating. So for the ones that do, those really tend to be very outstanding plans. You see a lot of neutral rated plans. That's very typical year over year, where plans that don't really have any huge flaw but also aren't really standing out from the pack. And you'll also see very few negative rated plans, which is an indication that a lot of the industry as a whole has done a relatively solid job. So diving into some of the ratings. On this page, I've highlighted our gold rated plans. So two of them have been gold rated since actually going back to 2011. That's Vanguard and Utah's plans. Vanguard's plan is, which is based in Nevada, very straightforward. It's low cost, broadly diversified Vanguard indexes, and although a lot of plans also use heavily Vanguard strategies, this one has leveraged its economies of scale to offer even lower prices than some of its peers. It's the third largest plan in the nation, and investors, they actually lowered fees this year. You can buy the age-based options for 17 basis points, which is down from 19 last year. So that really sets it apart from a lot of its peers. Utah's plan is also a very strong option. we see very strong oversight from Utah in terms of their plan. They're definitely looking out for shareholders' best interests, look for opportunities to lower costs, and they also offer a unique aspect where investors can customize their portfolios and their age-based options, while also offering a variety of investments. While they offer primarily Vanguard strategies, they also offer some DFA funds for a little bit of variety. One notable change this year was Virginia Invest 529, which is Virginia's Drexel plan, which we upgraded this year. So the plan was already an extremely strong option. The asset allocation approach within the age-based options is a very thoughtful one. It's extremely well diversified, and they actually have an open architecture approach, which means that they can select managers from a lot of different investment shops. And while not all plans that have that have used it to their benefit, this plan has done a really good job at selecting strong managers from a lot of different firms. And what boosted the rating this year was that the plan was able to lower fees a pretty significant amount by reducing its program management fee and also swapping to some cheaper underlying share classes within funds. You can buy the age-based options for an average fee of 43 basis points, which is really attractive considering that the heavy use of active management. Looking at these silver-rated plans, so these are also very strong investment options. In some cases, there's a little bit of room for improvement, but overall, we think investors will be very well served by these. One notable change here is a couple of plans managed by T. Rowe Price. They have been rated gold actually since 2011, but we downgraded them this year to silver, which is still a very strong vote of confidence. But there are a couple things that led to the downgrade. One, you've seen, while the underlying manager lineup remains very strong, you've seen some of the quality of the underlying managers come down over the past couple of years. Morningstar analysts that cover a few of their strategies have downgraded a few of those. And additionally, you've seen, given the size of the assets that T. Rowe Price manages across states, we think that fees could be a little bit lower. Their fees look about average relative to peers that use primarily active strategies. But given the asset base, we think they could be slightly lower. So overall, the changes merited, or those aspects merited a downgrade, but still strong options. Another notable change this year was Missouri's direct sold plan. And it's not often that you see a plan that goes from a neutral rating to a silver rating, but we wanted to. The plan made some significant changes, and it earned that change. So what they did is actually in an effort to leverage their economies of scale and to offer investors a single best-in-class option, they actually collapsed their advisor-sold plan to their direct-sold plan, which allowed them to lower the expense ratios on their investment options and also allowed them to eliminate a $10 account maintenance fee for investors. Additionally, they added some variety within their options. They use primarily Vanguard strategies, but they added some standalone DFA options and replaced some actually more expensive Vanguard strategies with them. So overall, the changes reflect very strong oversight and give us a lot of confidence that it will continue to be a strong choice for investors. There wasn't a whole lot of change in bronze-rated plans this year. One big change, though, was the 4 plans that are run by Fidelity. So we actually upgraded these plans from neutral to bronze over the last year. There were 2 things that drove that. One, we've become a little bit more comfortable with their tactical allocation process. 2 years ago, they introduced tactical management within one of their age-based tracks that's heavily used across the plans. And Fidelity at the time did not have a public track record in tactical asset allocation, so it added a significant amount of uncertainty and led us to downgrade the plans to neutral. However, over the past couple of years in observing their moves within the space, it's been evident that they're operating within fairly strict guardrails, and while it's not long enough time to judge their aptitude within the space, it gives us confidence that it won't take performance meaningfully off track. And additionally, we saw Fidelity cut fees on their index-based options, which are now among the cheapest in the industry. So overall, it made sense to upgrade their plans. And one other thing I would mention is that we initiated coverage on 2 plans from Rhode Island, their advisor sold and direct sold plans. This year they changed their program manager from Alliance Bernstein to, they hired a Census as program manager who partnered with Invesco as the asset manager. So their direct sold plan received a silver rating, and that is actually a rating that applies specifically to in-state residents. It's almost owned entirely by Rhode Island residents, and those residents receive extremely low fees. So it makes it a very strong option for them. Their advisor sold plan is also strong, not quite as strong. The fees are low, not as low. The underlying investments are solid, but not quite as strong, so it receives a bronze rating. I skipped the neutral rated plans because there was a lot of them, and also they just generally tend to be unexceptional. So I'll just jump right to the negative rated plans. 2 of these plans are rated negative primarily because of fees. So South Dakota's College Access 529 plan and Hartford's Smart 529 plan are among the most expensive within the industry. We had South Dakota's College Access plan as negative for a while now, but this year Hartford joined the ranks. And actually, it's a case of by not changing, you can fall further behind. So as the industry as a whole continues to reduce fees, if you're not changing your fees, you become more of an outlier. And Hartford's expenses over the past couple of years, actually they went up slightly in 2015, and then over the last year they didn't change. So anyway, considering that, and in addition, both of the plans, the age-based options, and this is something I'll actually talk about later in the presentation, but they follow a fixed or a stepped approach where there are big reductions in equities on individual days as the beneficiary ages, which we definitely view as not a best practice. So we think that by reducing some of those step sizes, they could also improve the plans. And then lastly, the third negative rated plan is Ivy Fund's InvestEd 529 plan. And that's largely driven just by overall concerns at the parents. We've rated Waddell & Reed, the parents, negative for a while now. There's been a lot of high-level turnover at the firm at the portfolio manager level and senior management level. Phil Sanders actually took over as CEO just several months ago, and he seems to be making some changes in the right direction, but it will definitely take some time for dust to settle. So overall, we think that investors can find better options elsewhere. And additionally, some of the turnover at the firm has directly affected the plan because you have new managers that are running the age-based options, and they have a lot of flexibility in adjusting allocations, and they don't exactly have a proven track record in tactical asset allocation. So all things considered, we think that the plan deserves a negative rating. Moving on to trends within the industry, one trend that you have been able to very consistently rely on year over year is reduced fees. And actually, looking at the 6 plans that we upgraded this year, all 6 cut fees. And that is not the sole reason for the upgrade for all of the plans, but it's at least interesting to point out that, or at least we obviously view fee cuts as a good move and try to recognize plans for it. Another thing that I'd like to point out is that as the industry has been cutting fees so significantly, now you're seeing still fee reductions, but in some cases they're to much smaller magnitude, which makes sense. So for instance, Georgia's Path to College plan reduced fees by on average 3 basis points. Nevada's plan reduced them by 2 basis points, and California's Scholar Share reduced them by 1 basis point. So the fee reductions at a lot of plans are continuing, but they're becoming a little bit smaller. Even though they're small, we of course think that it's a good idea, and obviously works out for investors and college savers. Another trend that permeated across the industry has happened within their cash equivalent options. So because of money market reform, you've seen nearly all plans remove retail money market funds, and they've been replacing them with either government money market funds or stable value strategies. And in general, you continue to see stable value gain a lot of interest within the industry. As far as stable value strategies are concerned, in our view of them, we don't necessarily have a preference for as a cash equivalent to use stable value or a government money market fund. We think that either can work as a cash equivalent, but of course, stable value strategies can be complicated, and it's definitely important to dig into some of the details. But either type can work from our view. And lastly, we wanted to touch on a final trend, which we've actually been very happy to see lately, is that, well, let me take a step back and just explain the two different types of approaches within the age-based options in terms of how they reduce their equities over time. So you have one approach, which is what we call a progressive approach or smooth approach, where the shift down in equities is very gradual, perhaps several percentage points over the course of an entire year. And by using that really smooth approach, you mitigate any market timing risk that might be inherent in making big asset allocation shifts in a single day, which is what you see within age-based fixed portfolios or the stepped approach. And actually, about 80% of plans use the stepped approach, which we think course market timing risk. What really matters, you can use a stepped approach with more moderate steps, but basically those plans that are using the bigger steps are ones that we think that there's plenty of room for improvement, and we've seen some of that improvement. Real quick, I want to show some analysis that we ran in this year's paper, which shows basically some of the risks that are inherent in using the stepped approach. So these different buckets show the sizes of the steps that were present in the industry as of the end of 2015. There were a couple tracks that actually had, at the most extreme example, a 50% step. So in a single day, they were cutting their equity exposure by 50%. And just to show the range of returns that you could experience during that, or with a 50% equity allocation, over the past 30 years, your 12-month return could have ranged anywhere from 32% to negative 22%. And then if on that next day, so that's the return you would have received in 1 year. And then the next day, if you shift out of equities by 50%, you're essentially locking in that experience. So we thought that this was an interesting way to show it and highlight some of the risks that are inherent in the process. And what we found through this is that a step that you could consider prudent would be about 10%, because that's where you see the range of returns start to level off at that point. So we're not saying that the stepped approach in general needs to be done away with, because we understand that that's a big process, and it can add a lot of questions and confusion to participants. But we think that if you do use that approach, you should take more moderate steps, such as 10%. So we've been very happy to hear from a lot of plans that there's been a lot of plans making strides to reduce the size of the steps. Notably, Vanguard has been offering to all of its plans the option to go from 25% steps to 12.5% steps. In our view, that would represent a meaningful improvement, and we would encourage plans to accept the offer to reduce the size of steps. Union Bank and Trust also has been reducing the size of their steps. They, across all their plans, went from 20% to 10%. USAA increased the number of age bands from 6 to 9, thereby reducing the size of their steps. And also over the last year, American Century, they were the example of the plan with a 50% step within the glide path. But within the last year, they addressed that, and actually think they cut it in half to reduce that kind of market timing risk that it introduces. So definitely, we have been happy to see this trend, and we hope it continues. And just to show what the landscape looks like in terms of the size of the steps that are present, and this was as of the end of 2015, so it's changed a little bit since then. As I mentioned, there are no more 50% steps. But where you're seeing the largest steps is within the 20 to 29% bucket. That's actually where Vanguard's plans fall with 25% steps. So over the next year, you will likely see size of that bucket reduce. And as this trend takes place, plans with more than 20%, especially plans with 30% and 40% steps, will become even more outliers, and it'll become an even more inherent disadvantage that exists within the plan. So anyway, it's an interesting development. And that wraps up the webinar for today. We really appreciate everyone's time again, and please feel free now to submit questions through the portal, and we'd be happy to answer them. Actually, I have my colleague Susan Wasserman here with me, and we'll try to tackle all of your questions.
We see some questions coming through, so we've got the team here, and we'll start to address them in a moment or so.
We had one question about the appropriateness of a stable value strategy near the end of the glide path. We think that it's definitely a viable option. A lot of these plans they have overall, they tend to have very predictable cash flows, so they can manage it. That's actually one thing that we've heard as to why stable values become so popular, is that cash flows within 529 plans are extremely predictable, even more so as compared with 401k plans. So as a result, we think that stable value is definitely a viable option, and it's okay if it's a significant weight later on in the glide path.
Yeah, so we also got a question, are state tax deductions considered in your ratings? So we do recognize there are a number of states that offer fairly generous tax deductions. It's sort of hard to place it into any one of the 5 pillars, but in our write-ups we do certainly try to highlight the states that do have tax benefits that in-state residents should definitely look at, or might potentially outweigh maybe some of the higher fees in the plan. I would say that there are very few plans where the state tax deduction really swings the rating. So I think Indiana is one example of that, where the tax benefit is so large and so beneficial to in-state residents that Indiana residents really should not look elsewhere. So that state receives a bronze rating.
We have one question about how we compare, or how we consider, so all plans are offering age-based options, but they also offer standalone options that allow you to build your own portfolio. So how we kind of compare between the two. We tended to focus more on the age-based options just because they're so heavily used within the industry. On average, according to the plans that we speak with, about 65% or so of plan assets normally falls into age-based. So that tends to take the majority of our focus, but we definitely also consider the other investment options that are available, as we understand that there are plenty of do-it-yourself investors out there who want to build their own portfolios. So I guess the short answer is we consider both, but there's more emphasis on the age-based.
Just looking through a couple more questions, folks. We'll start up here again momentarily.
One question we got is there an option to select progressive plans versus fixed plans in Morningstar? So you can look at, you can pull all age-based options, and so that would mix a lot of different age-based options from all the plans. And there is a data point that's called option type, and it would say either, I think it's progressive or fixed, age-based progressive, age-based fixed. So you can look at that data point in Morningstar Direct if you're looking for some guidance on that. And also in our industry landscape paper that we issued earlier this year, just in May, you can find it on our corporate website, or honestly, if you just Google Morningstars 2016 529 College Savings Plan Landscape. Within that paper, you can find a list of plans that use progressive as well as fixed. We had one question about why are all gold-rated plans direct sold. So that actually, it's not intentional. It's just kind of how the cookie crumbled. So we do evaluate direct sold plans and advisor sold plans separately in terms of fees. So it's not intentional. It's just a result of our process. We have one question about how the fixed income components in plans try to reduce the chances of losing value in rising rate environments. So you've seen some plans adapt to this, not all. It's obviously dependent on their market outlook. But, well, for instance, one common thing that you've seen is Vanguard's plans have moved to like short-term inflation-protected strategies within their age-based options. And you've seen a number of other plans that have reduced duration, but it's really a plan-by-plan basis. And just to clarify, there have been some questions about the slide that showed fee reductions. That was not an all-encompassing slide. It was really just to show some examples of plans that had done it. So apologies if we left out any plans that you wanted to see in there, but we just wanted to hit the highlights. There's not enough room to go into all of them.
If you have any more questions at this time, please submit them through the Q&A box. We have the team here for another few moments, just looking through a list of questions. Okay, it looks like that is it for the questions for this afternoon. We'd like to thank everyone for taking the time on this post-Game 7 day for joining us. And we would like to let you know that we will be emailing out the replay of the webinar for those of you who were not able to attend the entire session today, who perhaps were not able to join us at the start time. So thank you again, and we wish everyone a wonderful afternoon.